Hey folks, welcome to yet another conversation on Business Redefined, your weekly most comprehensive look at the world of business, finance, and economics. We are right at the heart of the banking earnings sector. We've had multiple conversations. And of course, one of the big stories around these numbers is from Absa Bank. I sat down with the CEO, sat down with the CFO, and we want to drill into a more niched conversation on the consumer banking franchise of the business, how it performed, how the outlook is faring on, and we're privileged, as always, to have Triple M, Monsieur Moses Mudui. Karibu sana.
Thanks for having us, Julian.
Good to have you, Moses.
Thank you.
You guys had a stellar set of earnings. I sat down with the two top bosses. Let's drill to the franchise you lead, consumer banking. How did it perform in the year ended F25?
First of all, thanks for making time to have the discussion and obviously giving us an audience as a firm. I think the consumer business has been on a execution trajectory for the last 3 years. When we started off the execution of the strategy towards the end of 2022, mid-2023, we said that we needed to, more than anything else, reorganize the business alongside customer segments. Because unless you truly understand your customers, anything you sell makes sense. So we pulled the business into 3 segments: affluent segment, personal banking segment, and next generation customer segment. And then we said we'll offer products across those segments in a value-added manner. In other words, anyone who comes to you must be looking for more value. You must have more value for them than just a lending, a deposit transaction, and so on and so forth. This is the 3rd year of execution of that strategy. Last year, you saw us complete the build-out of the affluent business. We launched the wealth business, which is the top end of the consumer business. We also relaunched the prestige business, which is the lower end of the affluent business. And we've been working really hard to bring to market our next generation proposition. In the next few weeks, you'll see that come to market. The affluent business is growing rapidly. The personal banking business has continued to grow at the market, but at very good efficiency levels. And next gen, what we have today there is Timiza business, which was up 19% last year. I think at aggregate, when you look at the consumer franchise, really ahead of our plan to double earnings in 5 years. When we look at where we closed last year, revenue up 12%. Within there, I think the story is much on the non-funded income, which was up 21%.
I was going to ask you, how is the breakdown between the funded and non-funded? Yeah.
So 21%, which is back to this conversation of value-added services. Insurance grew significantly above 30%. Investments business doubled again last year from doubling in 2024. Cards business was up as an offering. Timiza was up as an offering as well. So the non-funded income, which tells us whether the client franchise is healthy. Are people transacting more with you? Are they using your products more? What else are they doing with the firm? That was up 21%. Portfolio quality significantly improved from what we saw in 2024, given the external environment challenges. So impairments were down 30%. We kept costs flat. Without any writing back any provisions of the cost line, the underlying cost, reusing the same cost that we have. We opened about 7 branches and kept headcount lower than the previous year. So we're reusing a lot of that cost base. And profits were up over 50%. We also got our ROEs headed the right direction, 28%. Cost of capital is 17, so a very good 10, 11 percentage points accretion, which allows us to deploy capital. So from a strategic point of view, we obviously pick lessons. There are things we could have executed faster, but the new businesses we've built, the segmentation we've put in place to really face the market as a customer-facing franchise, understanding customer segments, the build-out on the product horizontals, and the overall financial outcome is a pleasing one. And thanks to everyone in Absa who works very hard, as well as our clients who we serve every day through this business.
Moses, if you've been following the numbers which have been coming from your peers across the industry, the fact is that a lot of banks are taking the heat on the funded side of the business, understandably because of the loan repricing we had last year, courtesy of the central bank unwinding. My last conversation with the governor indicated he still sees further headroom for rate cuts in 2026, barring what we're seeing in the Middle East, which hadn't happened at the time. Does this signal to us that even for your consumer franchise, you'll continue askew towards the non-funded side of the business?
Look, I think, any banking franchise anywhere in the world has to think about its fortunes outside interest rates. Because interest rates go up and down. And you might grow your fortunes without growing the underlying business, which is, are you lending more to the economy? Are you paying people commensurate rates on their deposits? So that banking one-on-one, which is interest rates and volumes, is something that, yes, stays within the firm. But more increasingly, banks must ask themselves the question, where do we add value to the people we serve? How do we get more people, not just included in the system, but accessing financial services that are value-added services, whether insurance, investments, cards, payments, and so on and so forth. So I think the strategic way out through any cycle to grow any consumer banking franchise, and indeed any banking franchise, is what you're doing with your customers and whether you're earning a return, which is the non-funded side. So, we go through these cycles we see further compression in the margins. We don't think we are done yet. But does that mean as margins compress from probably those, mid-teens to low single digits, we close the shop from a financial management point of view? So the real driver that is more sustainable is client-led growth. Are you doing more with your customers? And are you earning something in return as you do more with your customers? And is what you're doing value-added services to your customers? So we see continuing strength in the consumer franchise on the non-funded side as we drive volumes, lending more to the economy on the non-funded side, on the net interest side, on the funded side. Today in March, we are probably in the consumer franchise lending twice as much as we did in January this year. So the volume side of it, as the cost of credit reduces, as pent-up demand gets fulfilled, as people get much more money in their pockets with lower rates and lower inflation to borrow, it goes and follows without saying that the volumes will also grow. But strategically, any banking institution that wants to continue generating a decent, good return on the financial side while doing what is right for clients, the non-funded side of the business is where I think the battleground is going to be.
If you're doubling your volumes between Jan and March, which is a very short window here, I'd imagine your loan book quality is significantly improving in that case.
So when you look at our loan book quality coming from 23, 22, 23, 24, 25, NPL's pretty much at the 10% mark. And obviously, if you grow your volumes and then the portfolio quality becomes a problem, it really questions your standard of origination, right? So you shouldn't be seeing any impact on your quality of your book based on what you're underwriting within the same period. Of course, you look for tail risks and you kind of model based on how much you're lending, what will happen to the portfolio quality, but it's never instant. Any portfolio quality issues that we're dealing with today is what you'd call flow to default. People who have been going through a stressful period or stressful events that you've seen stage through different stages, and what you do to help people not to flow to actual default. That flow to default management, which always follows after a high rate environment, is what we are dealing with now. And then on the provision side, I always say that when you take more provisions, if you're right, you're provided. If you're wrong, you have an upside because you get to release that. So it's always a net positive once you take care of your provisions at any given cycle. And we think we are adequately provided, and the coverage ratios are at the good levels as we navigate the credit up cycle that is this year.
How is the migration, Moses, around the shift to Casonia, given the sort of trend we have seen in the banking sector, where despite the migration, a number of banks are still leaning towards the CBR? What really is the issue with Casonia?
So I don't think there's any issue with Casonia whatsoever. Julians, and if you study any financial market anywhere globally, the accurate price is the market price. Whether it has sentiment, perception, or there are fundamentals driving that price. Where the valuations cross on buyers and sellers, whatever market,
that's the right price.
That's the right price at any given time. So in the financial services space, any market benchmark linked price is the accurate price. Casonia is one of those. It's like Sonia or SOFA, which have been with us on the corporate and institutional space for a very long period of time. The fact that now the regulator working with the industry says and has guided the linkage between the central bank rate and the market observable rate, which is the T-bill, and that corridor makes the CBR like any other market price, unless there's a massive dislocation, which we haven't seen and we don't anticipate. So the choice, I think, really boiled down to what are we ready for now? What are we ready for later? And what we were ready for now as APSA was CBR, which, as I said, is a market linked and is very much mimicking the market price as we developed our capabilities for Casonia. And then at the end of the day, the customers have a choice, especially our sophisticated institutional clients have a choice to be priced off any benchmark. I think for more portfolio businesses, it will be a very difficult conversation with my customers on the mechanics of Casonia, unless they've, your sophisticated clients. And so we must always make sure, one, is it transparent? Is it market linked, therefore transmitting the benefit to clients at the end of the day? And is it easy to execute? So if there are any delays between choice of one over the other, there are more operational execution delays than a firm choice on our side.
And on the monetary transmission bit, Moses, how much of a risk do you see coming from the potential spillovers from what you're seeing in the Middle East?
So obviously, what's happening in the Middle East is a rapidly emerging situation that no one saw coming. The International Energy Agency has said that this is perhaps the largest disruption they've seen in energy markets in the recent past. We see that playing out in the oil prices, futures and present markets. So you see that happening there. I think as the oil prices seep through value chains, this might be having different impacts in different economies around the world. For the economies where this important inflation will find low growth, that's a difficult scenario for any central banker anywhere in the world, because you're dealing with stagflation, which means low growth, high inflation. So therefore, do you increase interest rates to remedy inflation, or do you reduce interest rates to spark growth?
Hoping the FX remains stable.
Precisely, right? As the other moving component. So for markets where there's low GDP growth, it's a much more complicated affair. And the policymakers in those markets, and there are a few of them, you see them in Southeast Asia, you see them in Europe, you see some of them on the continent, is a much more delicate balancing situation. And of course, oil prices, yes, there's what you feel on the pump, but oil products and byproducts pretty much drive a lot of everything else in any economy. Yeah. And then, of course, there's Middle East as a trading bloc, is a source of remittances for, pretty much the whole of emerging markets. Kenya gets 10% of its diaspora remittances from that space. It's a market for exports. We export 20% of our exports go to that market. So the impact is beyond just oil prices at the pump. Eventually, if those go up, I think it's more what else in that whole ecosystem. And as a source of FX as an addition there. I think what is good for the Kenyan economy, and these are public statistics, is this event is finding Kenya in a very strong defense position. Look at FX reserves, $6.2 billion.
Massive. And Safaricom proceeds are coming.
Highest it's ever been. Look at diaspora remittances, $5 billion, going up. Look at interest rates, the lowest they've been for the last 36 months.
Yeah. Inflation.
Look at inflation. It's at the lower end of the target range. Look at currency. Look at external financing conditions with what we've done with our external debt over the last few cycles. So one could argue, sharing my own personal view here, that in the short term, if the situation de-escalates, we're pretty much in a good space. Over the long run, if the situation escalates, becomes a black swan event, no one can ever predict what happens in that environment. So I think net is really a duration risk, is what happens at what given time as we watch and observe whether this de-escalates or escalates. But Kenya as an economy is in a very strong defense position as this event unfolds.
But don't we have a considerable challenge given the fact that it could potentially have spillovers here in an environment where private sector credit growth is just recovering, still in the mid-5 horizon? We know we've been in the double digits and we are aspiring to get there, but now it just kind of hamstrings that sort of recovery.
The primordial role of banking is managing risk and financing risk. So this risk event is an event to be managed and to be financed. I think it's pretty much, look, we are here post-COVID. One could argue 1 in 300-year event, a black swan that no one saw coming. All of us were very optimistic. We thought it was an isolated event in a small city called Wuhan in China. And in 6 months later, we're where we were. And look where we are today in terms of what's happening on balance sheets, recoveries, economy recoveries, commercial activity, and so on and so forth. Once you apply that lens as any financial institution, you see the opportunity to finance and to manage this event, whichever way it comes. On the private credit sector space, we clearly have been on an up cycle. Yeah. We've been on an up cycle, credit cycle. We obviously watch what plays out in up cycles of credit. If there's any frothiness or aggression in parts of that credit cycle, we have to be alert using the tools and the models that we have. We see people leveraging up. We see balance sheet being leveraged up. It's consumer debt, it's big corporate transactions, it's government transactions. We see this leveraging up. As risk management experts would say, you want to be first one in of the cycle and the first one out of the cycle to the next one. Yeah. So this FIFO, just going back to the accounting knowledge, you want to be able to participate in that cycle, not too late into the cycle and not too late out of the cycle, because these things are cyclical. And by the way, credit cycle is a normal curve. Yeah, they go this way. We pretty much feel we were at the recovery stage of this cycle. Very optimistic that continues. If the short-term duration risk conversation that we just had about the Middle East plays out in the favor of the way we're optimistic about it. We've seen mobile credit significantly going up. We've seen consumer credit going up. People are borrowing more. We've seen corporate and businesses, particularly digital borrowing on the SME side, going up. We're seeing confidence from the large institutional players coming to the market, whether it's debt capital markets, equity capital markets,
yes,
or even a bank.
The rally has been quite something.
Right, private credit is also looking good. So we're very optimistic that this credit cycle is yet to continue, unless, as I said, there are any long-term black swan events that no one can predict at this point.
Let's talk about deposits. And deposits have been interesting in this earnings cycle for one reason, Moses. Everyone is looking at placing a firm lid on their cost of funds, but still there is voracious competition out here for every single deposit. How do you ensure you remain ahead of the curve?
Look, I think, the deposit franchise is really the signal that you have a strong client franchise. Yeah. Why would you keep your money in one bank and not the other? Why would you move it from one bank to the other bank? It's really the quality of relationship that you have with the bank and what else that bank offers you. Because there's nothing like lazy deposits. Everyone out there
is looking for yield.
Is looking for yield, right? In fact, I think zero interest rate earning deposits are things that are very quickly going to be transitory. Zero interest earning for a week, it moves in to a small investment, yes. Either money market fund and or a stock. Yeah. And or asking for a return, and or offshore for the big transactors. So I think we think the competitive advantage boils down back to, do you understand your client segments? Do you understand your clients? Are you doing well and doing good by your clients? Why should they trust you with more funds? Price is temporary and transitory. Anyone can pay any price to get deposits because the market is chasing yield. But there are reasons why people stick with the bank. So we see that as the philosophy of the underlying client franchise, client-led growth. There are more people in the system. What value-added services do you have for them? And so on and so forth, being where the advantage is. Obviously, I think the other side of that conversation is what happens to overall interest rates. Because if you're not paying parity to T-bill, why would anyone? Right? So as interest rates drop or go up, what we pay for deposits mimics what happens in the market. We think we're on a down cycle in terms of what we pay for deposits as overall lending rates come down as well. Hopefully, I think that corridor between cost of funds and yield, those who've managed their balance sheets with a little bit more precision, obviously that corridor follows, maybe with certain delays on the cost of fund side because you have deposits you locked for term on higher rates that will wash out over time. But
increasingly we are seeing banks just moving away from that because of the nature of the environment we are in.
Absolutely. I think, if there's any player out there who is significantly paying above where the market is, then maybe there's a need to double click on the portfolio and see what it is you're navigating. Is there a loan to deposit ratio issue? Do you have higher need for money to lend to the to the real economy? Therefore, you can mop up deposits. But I think the conversation boils back to doing well and doing good with your clients. That is the fundamental foundation of a deposit franchise.
Moses, as we dial down, something you touched on, and I think we should drill down a little further on it because of the questions I receive around it, is bank assurance. How is that business doing?
Look, I think the Absa bank assurance business has been on a transformation path. Today, that business makes what is above north of 1 billion in profits for us. It's the largest bank assurer in the market, not because we've got the largest customer base, but because we found a way to really tie to our client franchise our additional offerings. So if you borrow from me, surely I'll offer you insurance for that credit, whether it's credit life or additional cross-sell opportunities, or I'll give you a car insurance and or an endowment product and so on and so forth, education policy for your kids or your relatives. So the advantage of having a holistic offering is one where you can offer, these products to your non-insurance clients. You can offer these products to them. That business was up more than 30% last year. It's looking good this year. The year before, we saw some growth there. I think there's embedded insurance, which comes with credit borrowing, but there's much more to diversify on non-credit life based on where the demand is. In our base, we see probably 15% penetration, so there's 85% to go. So it's a growth opportunity. It does serve.
But equally, there are so many market entrants.
There are, and that tells you, there's opportunity, right? Yeah. There's a lot more opportunity for small businesses. If you look at the SME space, business banking space, corporate investment banking space. Some of the corporate investment banking clients would come with their own embedded insurance. They own insurance companies, some of them. So when you look at the middle market, right above consumer bank, that's another growth area. So it's a really exciting business. It's adding value to clients, generating a non-funded income for the bank, which is at zero capital. And as we invest in technology to distribute the products in different ecosystems, we see that as a growth area for us.
Moses, the competitive landscape in this country, and I mean banking in general, is becoming extremely interesting. We have seen the entrance from players from South Africa. We've seen coming from Nigeria as well. We've seen an Egyptian player coming in. How do you see, and we're having this conversation within the context of escalated consolidation because of the prudential changes we are seeing in the Kenyan market. How do you see the competitive landscape going forward?
Look, I think East Africa is becoming the bullseye for financial players on the continent. When you think about the big markets on the continent, Southern Africa, pretty much maturing, but still getting very disrupted by new players. Revolut has just gotten a license to operate in South Africa. Southern Africa itself, we're seeing different players who are not your conventional banking players coming into that place, but a growing market that is a little bit saturated and going through its transformation. You've got West Africa, a whole different dynamic as an economic bloc. You've got Franco and Anglo-Western Africa players, and that's another big market. You've got Northern Africa, but given commonality of markets is not as common to the rest of these blocks I've mentioned on the continent. East Africa provides a rapidly maturing, transforming, attractive market for any financial services player. And that I think when you look at just the dynamics of the continent, Eastern Central, of course the entry to Central as well. Eastern Central is a growth basket for financial services players. The economy is transforming, more people are coming to the fold. People have entered what is digital financial services, but they're asking for access. What more can I get? So, big transactions that are done in the region are probably done out of Nairobi, and the bankers flying in and out. You've got offshore wealth and offshore clients with monoline private banks in Switzerland, and or wherever they're in the world, coming in to just look at this opportunity. I think in terms of new players into the region, every domestic market requires strong, solid domestic banks, and I think in Kenya we've got that. But every regional economy equally requires strong regional banks. And so the interest on the subcontinent of East Africa and Central Africa is pretty much the realization that as an economic bloc, East and Central Africa requires strong regional players who can underwrite. As domestic players do what they do and go across borders, regional players with the balance sheets, the capability, the capacity, are also seeing this as an opportunity to underwrite a strong regional economy that requires strong regional banks. I think that's a business case there.
And interesting you say that, because one of the conversations I had with Kenny Fila when I was in town, he said that one thing he believes that South Africans banking sector can borrow from East Africa is the digital distribution. And maybe that speaks to the appointment we're talking about. But just speak to us about that reverse impact you're seeing happening, especially in terms of how the East African banking landscape now impacts Southern Africa.
You know, I mean, as you travel around the continent, you get a real sense that different people are great at different things. And they're early adopters on digital finance. You know, they are early adopters of new markets to underwrite risk, and we're seeing that happening in Ethiopia. But certainly one of the gift, and 100% agree with Kenny, is that East Africa transformation from a digital finance landscape point of view is not just a case study for the continent, but it's a case study globally. And so being able to, you know, export some of the lessons we have from this market to other parts of the continent, despite their different dynamics, and there are different dynamics in every market, is one of the benefits of, you know, leveraging, you know, for any player looking to diversify, whether it's capability, capacity, intellectual property. And it's also symbiotic. You know, there are things that we are still very much in the stage of developing. When I look at, you know, what financial services players offer in East Africa, the whole sophisticated underwriting and structuring of the very complex investment banking transactions is something that we can learn. The whole offshore banking space is something that we can learn. So I think these markets are symbiotic. And once you anchor yourself in Southern, Eastern, and Western, I think you're pretty much covered.
Chris is flagging me that I've overshot my time. Moses, give us your parting shot.
Look, I think it's, you know, as APSA, always fully committed with the consumer franchise to do what's right for customers. It's a growth business within a growing firm. The future looks transformative with the appointments that have been made and what we feel we have. At the end of the day, if we do right by the economy, you know, if we keep the lights on during the good times, the not so good times, and the difficult times, I think we would have done our role. And it's a collective effort. I think we always say, you know, we compete for profit but collaborate for purpose. There's a lot of collaboration opportunities for industry players for us to take Kenya to the next level.
We've been having a conversation with Triple M, Moses Mudhui from ABSA Bank, speaking specifically about the consumer banking business and how it is driving growth for the bank and for the industry, and of course touching on the macroeconomic environment, including the latest development in the Middle East and the potential spillovers we are likely to see on this market and how they could impact our operating landscape. We shall keep on highlighting these issues as and when they happen, so keep it business redefined.